So throughout this whole process, I've been pretty calm and composed, apart from crying about 16,000 times. But I'm very happy that I did not sell off all my holdings. So as you can see here, we are back to my trading 212 stocks and shares ISA. My current value is £107,778. You can see that we've had a decent week, up by 2.8% or a return of £3,000. And just as another reference, I was at £116,000 in cash not too long ago, and at one point I was down all the way to a value of £96,921. And if you were to ask me why the sudden drop, I will tell you that I went all in the iShares Core S&P 500. As you can see, this fund here I bought at hindsight a bad time, but you know what, you can't really always know where the future is going to go. But on the 24th of February, as you can see, and since then it has been a period of a rather large decline. However, currently I am down by only 7.92%, a loss of only £8,967. Now over here on my Trading 212 Invest account, you can see I put in another wad of cash into the iShares Core S&P 500 once again. And overall, since investing, it is down by a rather large 6.44%, or a loss of £1,388. So why am I glad that I didn't sell out? As you can see, over the past week, there has been a lot of volatility. At one point, we were at a value of £103,000, and now we are at a value of £107,000. So yes, this is not a very normal time in the market. We haven't seen periods of instability like this in a very long time. Just look at this. This looks like a jigsaw, not a portfolio. As always, I'm always showing you these updates on my Trading 212 portfolio, and if you would like to sign up to Trading 212 and receive a free fractional share worth up to £100, all you have to do is to click the link in the description box down below. Alternatively, if you've already signed up to Trading 212 in the past 10 days but haven't received your free fractional share, all you have to do is to click the three horizontal line menu over here. Scroll all the way down until you see the section use promo code, and in this section just use my code JUBAIR and you should receive a free fractional share. Now as I speak, the S&P 500 over the past week has been doing pretty good, as you can see, on an upward trajectory. Now as with all of these videos, it can go either way. There could be a massive drop the second after I stop recording, or the S&P 500 can keep going up. The only certainty we have in the stock market is that no one really has any certainty in the stock market. Unfortunately, no one knows where it's going to go, and if it did seem like someone knew where the stock market's going to go all the time, they're probably just getting lucky. Now in periods like this with the instability, it is very tempting, like I said in my previous video, just to sell off my holdings even at a loss, because there is an anticipation that maybe, the dip is just around the corner, the real dip that hasn't, dipped yet. When we look over for the past 6 months, you can see the dip was actually pretty huge, about a 20% drop. Now, of course, with all the instability, for example, the interest rates in America, the tariffs, and all the bubbling potential problems we have between, countries and neighboring countries and countries all around the world, not to forget the cost of living crisis and, wealth inequality, all that stuff, it stands to reason to believe that this might actually just be a bubble. It's going to pop and it's going to hurt a lot more people. People are selling out now in order to minimize their losses. Now, yes, it does seem very tempting to do that, because at the end of the day, this is my money. If I can save some money or make more in the long run, I would pretty much do anything within reason. Now, obviously, I'm not just going to sit here and tell you what's going to happen, because like I said before, nothing is certain in the stock market. But all I do know is that I am happy that I have not sold out my holdings. As you can see, to be down by £9,000 in just one of my holdings is very, very hard to see and very hard to stomach. Now, let's say I did sell out last week. Today, I would be feeling really bad about myself, because the stock market, as you can see, is rising. Now, the biggest news to the stock market this week is all about earnings season. Now, as we have already established in the past, pretty much right now, the S&P 500 is a glorified tech ETF, which basically just tracks tech companies at this point, because it is so heavily weighted towards these tech companies. Now, it stands to reason that with earnings season around the corner, with some companies in the Magnificent Seven, for example, Google already, releasing their earnings report, investors are going to hold off. When I say investors, I mean, institutional investors and retail investors in the masses. If the earnings reports comes back within expectations, then, that could change the direction of the S&P 500, even if that is temporary. Now, this video will be out on the same day I'm filming filming it. So after this video comes out, Microsoft will be releasing their earnings report, a big company in the S&P 500. Not only Microsoft, but Meta will also be announcing their earnings report. So this video has a huge potential of aging like soured milk. So what is the game plan then? What happens if the S&P 500 reaches all-time highs again? What are we going to do going forward? Are we going to stay in the S&P 500 or are we going to change our tactics? Now, this is something I have been thinking about a lot recently. I would be quite inclined to potentially sell at all-time highs, therefore not actually realizing any losses, and then potentially getting into an all-world fund. Now, obviously, this is not ever financial advice. I can only just share my own journey. But one of the all-world ETFs that, tickles my fancy, so to speak, is the Invesco FTSE All-World. You can see that over the past year, the fund has returned only 3%, which is really bad, but a huge part of it is still American markets. That's the thing about, an all-world fund. The average all-world fund has about 50 to 60% exposure in the USA, so you're still heavily manipulated by these 7, tech companies that have a really heavy weighting in the United States of America. So you can see over the past 3 months, this fund has returned a negative 10% essentially. And it just goes to show that, it's really hard to avoid America at this point. But why would you actually want to avoid America completely? It doesn't really make much sense to do that. It's still the largest economy in the entire world. And, you would be quite mad, in my opinion, to completely avoid it. So make sure to check out some of my other videos and I'll see you in the next video.